What about if we talk about getting cheaper insurances? And then if we're talking about maybe the insurances that we look at, Billy, the life, total disability, income protection and trauma, if we just touch a little bit on those and how you can structure or package them up and what sort of options are available and what we look at for clients. Can we unpack that a little bit?
Yeah, like most people just know that, oh, there's probably some insurance in my super, or yeah, I logged into my super and clicked that I wanted some insurance. That's as far as most people get if they're DIYing this stuff. But as we know, there's a lot more going on with those types of insurance, because like if you look at private health, everyone's entitled to private health cover, pretty much covered for everything, like everyone's the same. It's very much not the case with life insurance, income protection, total and permanent disability. You're not entitled to cover, you're not entitled to a claim. They generally don't cover pre-existing medical conditions or illnesses. So you could go and buy a whole bunch of insurance and then a year later something happens and then you could find out you're not entitled to any payout because
Welcome back to the Winners Playbook. Josh here with Billy. Home, car, health, and income cover have all crept up. Cutting cover is risky, but so is paying for things that you do not need. Today, we're going to be showing you how to trim costs the right way and keep the protections that ultimately matter. But before we dive into our topic, Billy, I'm going to throw to you as usual. And what's happening on your end, mate? And what's the news for the week?
this week, thanks, Josh. Well, we've done a bit of, like, I speak to fund managers and go to those economic updates and things like that a bit. So I've done a couple of those sorts of sessions in the last day or two. The latest news, and it's relevant to what we're about to talk about, is we had this massive inflation reading in Australia, which has basically killed off any prospect of interest rate cuts for at least, well, I would think at least the next few months, which isn't great for mortgage holders and businesses. But the presentation we went to yesterday, one of the guys presenting, his name's 𝗂𝗂𝘁𝗂𝗂𝗏. So he writes for the AFR and
Oh, yeah, good.
very big name in amongst economists and so on. And he thinks there's no rate cuts coming in the US either. And we're going to see, this inflation, unfortunately, lingering around. But the good news is there are a lot of positive signs out of the economy more broadly. So it's not all doom and gloom, but if you're hanging out for those rate cuts, maybe that's not going to happen anytime soon, unfortunately.
So the Santa Claus rate cut not happening.
Don't think so. Don't think so. About yourself.
Yeah, what's been happening? Bits going on. Obviously, the new office is ours next week, so that's exciting. So we'll pick that up on Wednesday, Thursday. I think we get the keys, so that's good. Fit out will start happening there, which is exciting. And in personal life, Leon's actually turns one next week, so we got his first birthday, which will be exciting. And this during the week, I've been still regularly doing my regular sort of training regime. I've gone into another class in jiu-jitsu, which is quite fun. So now I'm starting to actually roll around a bit and get suffocated by the higher belts and more experienced people. So it's always really fun. And yeah, on the Wednesday is where I get to do a bit of rolling around. If anyone knows like what that means in jiu-jitsu, is like that's kind of like when you're grappling. And so I get to sort of roll around with my instructor, and he's just like a blanket. This is the way I can describe it. It's like there's just no space for me to do anything, and he's got me in these positions, and I'm just like I actually don't know what I can possibly do. Like I'm just so helpless and vulnerable, and he's just smothering me and just does whatever he wants with me. So it's quite fun. It's a good reality check to life, I think. So just a long way.
Interesting imagery in my hand here. And what's the age range at these things? Like, because I feel like if I tried to do that, I would just get wiped, like the upper end. I mean, I feel like
no.
2 seconds.
In that class, there's a few boys rolling around in their 50s. There's a few up there in their 50s. Yeah. One of the highest belts there, I think, on the Wednesday. He couldn't be under 55. And
Are they just been doing it forever, or does some of them jump into it?
It's a fair journey. No, it's a fair journey. So I'm at the beginning of the journey. It's one of the martial arts that does take a while to get through. Like when I got my black belt in karate many years ago, that was 4 or 5 years. Whereas to do a black belt in jiu-jitsu, you're probably looking at like 8 to 10. So it's a fair journey. And there's a few brown belts in there, which is like you're right up. That's just the step before black belt. Whereas I'm just down at the white belt with 3 stripes actually. So I'm a complete novice. So I'm basically just like the punching bag of the class, and but I get in there and have some fun though, because I've done some training in the past. So I'm not a complete novice. I do know how to sort of handle it, but yeah, it's always good getting taught a lesson by some of these more experienced people. But anyway, shout out to anyone who does jiu-jitsu. I love it. Talking about insurances. So yeah, insurance costs, well, all costs in general obviously have been rising a lot over the last couple of years. Insurance is one in particular that everyone kind of gets hit with and can't avoid. I know me personally, I see my car insurance, I think it was last year, step up a ridiculous amount. And I think it was like 25-30+% in the year. And I was like, hang on, this is not, there's something wrong here. Called the insurer immediately, asked a few questions, and then ended up getting my policy down to lower than what I was paying beforehand. So I guess the theme here of what we're going to be going through is like, you've got options and you just got to not be lazy and be proactive around the exploration of those. Because talking to that one, which was a car insurance policy, I called up the insurance, said, what's going on here? You know, the reason why the cost went up, yeah, whatever. Okay, what are my options? Or I'm just going to go to another insurer. And then they basically asked me a few questions and said, well, how much Ks do you do a week? Do you do work from home? And I'm like, yes, and answer those questions. And they're like, well, based upon that, we can actually apply an instant discount to your policy. I'm like, okay, great. That's good. What else can we do? And then I actually ended up adjusting my, my excess a little bit. And it actually brought down the premium quite significantly to the point where I was like, oh, that's actually a great outcome. But, you know, most people probably wouldn't be doing that and wouldn't be proactive. And they would just see the bill tick up in their credit card or their bill account or whatever it may be and not even notice it. And yeah, I look at my finances really actively, and not everyone's probably like that. So that's a reason why you need to look at your bills. And if you see something spike up, well, check that out straight away, because sometimes these companies get it wrong as well. But yeah, we're not going to be just talking car insurance, obviously health insurance, all of the insurances that we work with as advisors, like life insurance, total disability, income protection, and trauma insurance. All of it's on the move. But if we dive into it, Billy, you know, what are some of the policies that are really sort of hitting Aussies out there?
Well, it's across the board, Josh. I mean, I think there's a couple of things going on. Obviously, we've just broadly had high inflation, so the cost of everything's going up. But with these insurance companies, because their policies are like they're sort of considered a necessity, right? So I feel like they can make sure they can protect their profits. So they're just going to jack the prices up to whatever level they need to make sure they're still viable and making money. So that's why I think we've seen particularly high inflation there. They also, you know, it goes back to what you were just talking about. They punish loyalty more than anyone else, right? So if you sit there and do nothing, they'll just jack your costs up every year.
Yeah.
If you call them, they'll be like, oh no, this guy's shopping around. All right, what deal do we need to do? So yeah, it pays to review all your major insurances every year. What are the main ones? I think everyone knows this: home and contents, car, private health, which is, there's a few things going on there because that's not actually a necessity. And I think we've seen a lot of people ditch their private health because of these price hikes. And then there's all the insurances we deal with, life insurance and income protection. But funnily enough, those sorts of policies we deal with, they've been jacking up their prices for like a good 5 or 6 years now. They've been jacking them up 20-30% a year. So yeah, add it all up, yeah, it's a huge impact on your budget.
And I think that's a good one to talk on, because there's a term, or like generally premiums are either stepped or leveled. Now, not all insurances are the same, but the ones that we're working with, you can either take out a stepped or a leveled premium. And yeah, historically, the stepped premium is the one that starts off cheaper for you, and it like sort of steps up, like you're stepping up the stairs. Say it starts off at 100 a month, then it goes to 105, 110, 120, 150, 180, and then the older you get, it basically gets more and more expensive. But it starts off really cheap. So it's quite appealing from that perspective, but then longer term gets really expensive. But then historically in the past, there were leveled premiums, which is when I originally took out my insurances, being life insurance, income protection, etc. I took out a leveled premium because I'm like, well, I'm young. I'm going to lock in this insurance cost because that's what you do with the leveled premium. You lock in that insurance cost, but you pay more to begin, but then your premium stays the same over the years, unless you've got an indexed policy where your sum insured goes up, but let's ignore that. So I actually did that. And then it was, I think, 3 or 4 years ago, the insurers came out and then hiked their leveled premiums. And I was like, hang on. Like, I just took out a leveled premium a couple of years ago because it wasn't going to change on me and I was going to hold this thing long term and I wanted to save money long term because I was actually paying more initially. And then the insurers came out and basically they all started hiking their leveled premium. So it then actually it made me think, well, what's the actual benefit of trying to lock in a leveled premium these days? I actually haven't personally recommended a leveled policy for a client in forever. I don't know if you have lately, Billy, but I see some of them that are older leveled policies, which if they're an old leveled policy, they're generally pretty good and you might not touch it. But recommending a leveled premium for a client nowadays, when that, like, I've just sort of like lost full belief in doing it, when the insurers at any point in time can still adjust the policy terms and the costs associated with you. I'm not sure what your view is on that, Billy, but yeah, that one sort of burnt me a few years ago.
Yeah, I completely stopped recommending it. My policies are level because I did them in 2015 or something.
Nice.
And that has paid off. But yeah, I could get a letter saying, oh yeah, we're putting your prices up 30%. That could happen at any point. So yeah, it's all a bit sketchy, that stuff.
Yeah, it is. It really is. And I guess the power's really with the insurer as well. But look, we won't probably spend too much time on the general insurances that are around, like home contents and build insurance and so on. But maybe worth touching on like private health insurance, because that is one that we do talk to our clients about when they're earning over certain amounts, because then the Medicare surcharge can start to kick in if you don't have the basic level of hospital cover. And that was definitely one I learned about earlier on. And when I actually looked at it, the cost of getting that basic hospital cover and then even having some extras on the policy was still going to be cheaper than not having it and just paying the Medicare levy surcharge. So I actually looked at it and was like, well, cool, I can just get some private health insurance here, get the basic hospital cover, which would then make me exempt from the Medicare levy surcharge. But then I also threw in some extras, which has got nothing to do with the Medicare levy surcharge. But I was like, look, I'm going to be paying the surcharge anyway, or do I just take out this cover and not pay it and then get some extras on there like dental and so on and so forth? And it worked out to be a pretty good deal. Do you generally tell or talk about your clients with on the higher incomes, Billy, for that one?
Yeah, most of them have private health, but if they don't, it's actually very rare that I see someone who's paying that surcharge, because most people do have private health at that income level. But yeah, generally speaking, you should have private health if you're in that Medicare levy surcharge bracket.
Yeah. And if we
the only main thing there is the pregnancy cover, as you know. If you take it, if you had the pregnancy cover, it's like not cheap the cost or something. So don't let that one sit there for any longer than you need it.
You kind of get that one and you take it off soon as baby comes out. So on the week, actually, that's a really good point to mention though, is I think I've mentioned it on the podcast before, but a massive lesson learned that we had when we were planning to have Leon is, most people are generally aware of that 12-month waiting period with the pregnancy cover. So if you want to have a child and you want to get the pregnancy cover, you've got a 12-month waiting period that you got to get through, and the baby basically can't be born within that 12-month period or you're not covered. So, in simple terms, everyone's like, okay, well, how long's the pregnancy period? Well, it's 9 months. So we wait 3 months, you do the math, you got a 9-month pregnancy. So you'd wait 3 months and then you're kind of in the clear and ready to go at that point in time, because you've got a 9-month waiting period for then the birth, and that gives you your 12 months. However, what we then learned is we thought that was then the case. And lo and behold, so we went through our 3 months and then my wife fell pregnant like straight away. But we're like, okay, that's all good. But then, so this was a massive lesson learned. But then what we learned is the actual birth of the child. At that point in time, the child was already a month old, because it went back. It started from my wife's last cycle. So at that point in time, and again, this is getting into the weeds of which I'm not an expert of. or when the egg was released. Basically, when we thought we just found out we were pregnant, my wife was already a month pregnant. So, and so realistically, you have to give yourself an extra month buffer, or you're going to end up like what we did. So then we're like, holy crap, how's this going to work? Our 12-month waiting period, I think, was up on it was like the 27th of October last year. And then Leon was scheduled to come out early November. So we're like, what? Well, we've cooked this. Like, what have we done? Like, we've got all this, we've got cover now. And it's like, is there a point of keeping it, or do we get rid of it? So we called up the insurer, and they're like, okay, we're going to give you a 2-week grace period. So even if Leon was to come earlier, yeah, we got it in writing, of course. We said even if Leon was to come earlier, we're still going to cover you for the pregnancy cover. We'll still give you the coverage. But the interesting part would have been, though, is if he did come earlier than the 2 weeks, which could have happened. He came a little bit later in all, so it was fine. But the insurer never told me about that when I was taking out the insurance. The people on the phone just basically said, yep, you've got a 12-month waiting period. You wait your 3 months and so on, and then you're good. But it's actually not the case. So that one was a huge lesson learned for me, which I've never had anyone tell me about that. But so hopefully someone can listen and not nearly make the same mistake that we did. So you really got to give yourself 4 months before you start trying, is basically what you should be doing, so you don't run it tight like me.
Well, Josh, we might have to bring my wife on a podcast because she's a midwife. She can explain all of these things to her.
Yeah. She can get into the science of it.
Also, the baby can come out early, so that happens too.
Yeah, so that's probably more of the reason why you should probably give yourself at least 4 months before you start trying here. Because if the baby comes out early, you're cooked. So at that point in time, which is not good. And yeah, the insurance is not cheap. So what about if we talk about getting cheaper insurances? And then if we're talking about maybe the insurances that we look at, Billy, the life, total disability, income protection, and trauma, if we just touch a little bit on those and how you can structure or package them up and what sort of options are available and what we look at for clients. Can we unpack that a little bit?
Yeah, like most people just know that, there's probably some insurance in my super, or I logged into my super and clicked that I wanted some insurance. That's as far as most people get if they're DIYing this stuff. But as we know, there's a lot more going on with those types of insurance, because like if you look at private health, everyone's entitled to have private health cover, and you're pretty much covered for everything. Like everyone's the same. It's very much not the case with life insurance, income protection, total and permanent disability. You're not entitled to cover. You're not entitled to a claim. They generally don't cover pre-existing medical conditions or illnesses. So you could go and buy a whole bunch of insurance, and then a year later something happens, and then you could find out you're not entitled to any payout because the medical event was relating to some pre-existing medical condition you had before you took the insurance. So it's a bit more complex. So with anyone who sees a financial advisor, the advisor will usually recommend retail insurance policies, which means you're applying directly to the insurance company, so not via an industry super fund or something. The reason we do that, there's a couple of reasons. One is we can make sure that we know what you're going to be covered for. So if you have any pre-existing medical issues, we across that before you take out the policy. The other reason is it actually often ends up to be cheaper because you can shop around and quote all the different providers and find the best pricing. And probably the other main reason is there's some of these insurances you can't hold through super. So we can make sure we're covering everything. So there's a bit more going on there. In terms of the super versus non-super, that's probably important to know as well. Usually you would have life and total and permanent disability cover through super. You can put income protection in there as well. There's a fourth type of insurance called trauma or critical illness. That one can't be in super. So if you see an advisor, you'll end up with policies in super, outside of super, etc. Yeah, if you're DIYing, it's a serious rabbit hole. It's quite hard to DIY the personal insurance stuff unless your situation's very, very simple.
Yeah, it is tricky because not everything's like for like, and obviously, you know, that's something that we do as advisors. We look at all those options because there's ways of making them cheaper where you bundle the insurance up, like you said. How much do you put inside super? Because like life and total disability insurance can get a tax discount or rebate when it's paid through super, but not when it's paid outside of super. Income protection is tax deductible outside of superannuation. Trauma insurance isn't. So it's definitely a bit of a minefield. And then when you get into actually the covers that you're holding, you can link the coverages up. Whereas if you take standalone insurance policies out, like a standalone life insurance, a separate total disability insurance, that's going to be more expensive as opposed to having a linked life and total disability insurance policy. But then there's other considerations. If we touch lightly on some of that, if you pay out on one, it will reduce the other if they're linked. So if you have a linked life and total disability policy, obviously you can't pay out on life insurance. It's irrelevant on the total disability at that point in time because you're dead. So it's irrelevant there. But if you have a linked life and total disability policy and the TPD or total disability component is paid out and you're still living, if in most simple terms, that might eradicate all of your life insurance because they're linked, so you can't double dip. But what some insurers do allow is something called like a life cover buyback or a buyback benefit to allow you to essentially sort of buy back or have the ability to reinstate the full sum of your life insured, so that if you were to claim your total disability, you could still claim the life insurance if you were to pass away down the line, and it would be cheaper holding policies like that than having standalone policies. There's a bunch of different options that you can have. So it's like, do you want no frills cover? Do you want all of the bells and whistles associated with your insurance as well? Because there's like premium levels, there's basic levels, there's those buyback options, there's reinstatement options. On income protection, there's super contribution options where you can actually add on that you want super guarantee or SG paid on your payment, or you might not want it. So it's going to be a bit more expensive. You can the one, I think a big one to talk about is income protection waiting periods is a big one, because you can have a real short waiting period of 14 days or 30 days, meaning if you're injured or ill and you can't work, you just got to wait 2 weeks or 4 weeks before you can go on claim. It's pretty quick, and it's like, well, that's great. I would want that policy, as opposed to maybe a 60 or 90-day policy because you're waiting 2 or 3 months to get a payout. But the difference between cost on that 2-week or 4-week policy waiting period versus the 90-day waiting period is pretty significant. Yeah, it can be quite costly to hold it.
So 30%.
Yeah, massive. And so yeah, I haven't recommended a 30-day I've probably done maybe 1 or 2 in the last couple of years, because it was a client who would not survive beyond 30 days if they did not have any income coming in, because they were like new into a new job, so they didn't have a lot of sick leave built up, didn't have much savings built up, didn't have anyone that they could rely upon. So it was like, no, they needed a 30-day waiting period. Generally, I look to opt for a 90-day waiting period because most clients do have a buffer. They've got some sick leave in there and some other things that they can call upon, and therefore we can roll with the 90-day to get the insurance cost down. I'm not sure if there's any others that you sort of see or talk about with clients. Is there, Billy?
Yeah, just sort of an example of this, of like with income protection, how these different features and stuff actually matter. I've got a client who's been a train driver for 25 years. He's got a huge amount of sick leave, like a year and a half of sick leave.
Yeah.
And not to mention, because, you know, being a train driver, there's a lot of risk there, right? And mental health risk and everything else. So if something happened to him, he would be pretty well looked after by the employer for a long time. So he does not need a 30-day waiting period income protection policy at all. Even 90-day was questionable. And it got to the point where, like, do you need one at all? Because, you know, he's built up plenty of savings and he's not too far off, say, accessing super and all that stuff. So he's at one end of the spectrum where he doesn't really need to spend a lot of money on IP. But then you've got someone, say, young kids, big mortgage, $2,000 in savings, no sick leave. Well, yeah, they need a really good policy.
Yeah.
Yeah. So, and then probably the last thing on that is there's also benefit period. So you go on your income protection claim, there's a maximum period of time they'll pay you for. The longest one is like all the way to 65 years old, or even 70 years old, I think, some policies.
Yeah.
So you go on claim, something really bad happens, you can never work again. You could be on claim getting paid every month by the insurer all the way through to retirement. That's expensive. or you can take the short benefit period where they'll only pay you for a maximum of 2 years. So there's all these features you can change around. It has a huge effect on how much, where the cost ends up.
Yeah, I think the way I always like to approach that with clients is, rather than we decide, what they should do, like we would generally do an analysis on where the shortfall is going to be. Like if something went wrong, what we think is the minimum that they should have covered. But ultimately, if someone wants to insure themselves for more because the coverage is quite cheap, like you can do that. Because, if you think about it, in the event of passing away, if you've got a family or you're totally disabled, you suffer a cancer, stroke, heart attack, whatever it may be, if the premium was irrelevant, you would want to have as much insurance as you can possibly have because you want to look after your family, your spouse, your kids, whatever it may be. So separate the premiums. You'd be like, no, give me as much coverage as I can get. So that's one way of looking at it. But then it's like, okay, well, that's not the reality of it. It's going to cost you some money. So then let's look at, okay, where's our baseline? But then, yeah, if adding an extra $1 million of coverage on your policy only costs you an extra $400 a year because you're so young, you might consider that. You actually might consider that. So I think with insurance in some situations, there's no right or wrong in some ways, but then there kind of is a minimum sort of threshold you should go down to, I think. But if you want to increase and have more coverage, or if you're like some people I see who are anti-insurance and don't believe in it, but then somehow they always end up still having car insurance, and then they insure their car, but then they don't insure their health. I don't know. I don't get that. But anyway, if that's the way you want to run your life, your call. Like you having insurance or a client having insurance doesn't affect us as the advisor. Like we're going to do our job and make it known where the shortfalls are and where we think you should be insured for, because it might compromise your family or this amazing wealth plan that we've just built that's going to fall apart if something happens to you. But ultimately, it's your call. If you don't want to insure yourself for those things and you want to run the risk of relying on government support or whatever it may be, it's totally up to you. Have you come across a few clients like that in the past, Billy?
I have the same approach because probably similar to you, Josh, in this profession, financial advice was sort of born out of life insurance, like back in the 80s.
Yeah.
And so probably similar to you when you first started in this world, there was the old school sort of advisor who was like, sell as much insurance as you can.
Yeah.
Because that's how they got paid, right? On commissions and stuff like that. These days, fortunately, it's not like that at all. And I'm the same as you. So I just say, here's the info, here's what I think you should do and what I would do in your situation. It's up to you now, because some people go, that's fine. My parents got loads of money. I'll just go move in with them if shit hits the fan. You go, okay, that's your choice. Everything's a risk. Whereas others say, I have no possible family help. My family, I've got kids and a partner. I'm the main income earner. I need to make sure this family's going to be okay no matter what. And I'll buy loads of insurance. So we just present our advice and the facts and the quotes, and then it's up to the client what they want to do.
Yeah, it's a bit of a weird one, insurance, when you think about it, because it's not something that's necessarily like people go out of their way to buy it themselves. Like it's generally sold, you know what I mean? And that's why there are insurance advisors or insurance brokers, because although it's like your life is the most important thing and protecting your family, I don't know, weirdly people don't really think about that, and it doesn't really cross their mind, I suppose, unless you've seen and experienced, people passing away or being hit with cancers, and you've had that reality. But everyone just kind of has this, not everyone, but a lot of people just think that it's never going to happen to them, I think. And then therefore it's just like, what's the point? Like, doesn't matter to me. It's I'm healthy. Nothing ever is. But then I think we all probably know of people that have gone through, and I've seen multiple claims, and I've seen the value of obviously having that. But it's to the point that you were saying earlier, Billy, is around insurance being sold. So historically, a lot of advisors used to just sell insurance, and people probably wouldn't have known this, but advisors back in the day, was it about 120% or was it more than that? I think
got to 130.
130% on a commission basis.
Yeah. So if you sold someone insurance, it's going to cost them $10,000 in the first year. Advisor got paid 13 grand up.
Yeah.
And right, I mean, they're done. They're like, right, move on to the next customer.
Yeah, see you later.
So and it wasn't the best system.
There wasn't a clawback either originally. So that's where the advisor was able to get you insurance, and they come see you 2 years later, and they're like, oh hey, there's a new and better deal out here. XYZ company, let's change your insurance over there and save you $1,000 a year. And then the advisor is going to change your policy. And they're going to collect another upfront commission. And that's obviously why the commission's changed, and that's all been halved now. And that's why a lot of Australians are actually underinsured, because there's not many people out there that want to work in the insurance space, because people just don't make money in it anymore. It's just not a good space to ultimately be in, which is a problem, because then a lot of people are out there are underinsured. But I always look back and laugh at this guy that when I first entered the industry, he was an old school advisor, and he told me he was actually from the UK, and he's like, Josh, if you're not, what did he used to say back in the day? If you're not churning, you're not earning.
Oh,
So I'm like, great, I'll remember that one. So I still remember it to this day, but I'm like, all right, so that's not what you should do. So
yeah, I've got stories like that. There was a guy who he used to go through the births, deaths, and marriages in the papers and call up all the new mums.
oh no,
Or there was even a story about a guy who used to hang around near the hospital, near the maternity ward.
oh,
We
brilliant.
just had a child. You're gonna need some life cover here.
I'm sure there's some good ones out there. I'm sure there's some good stories out there. No, that's interesting. Well, what about if we talk about the non-negotiables, Billy? I guess the way to approach that would be, it really depends on, your situation. And if you're a single person living at home, don't pay rent, maybe having $1 million of life insurance probably doesn't make a huge amount of sense in most situations. What are the non-negotiables in your view?
Yeah, well, just on this, can I ask, did you know this? Did you know with home and contents, with building insurance, if you're underinsured, like say your house burns down and it costs you $600K to clear, demolition and rebuild, whatever, and you're only insured for $400, you won't necessarily get the $400. So pay it out. So a lot of policies will only pay proportional. So I'll say you're underinsured by 30%. So you're only going to get 70% of what you're insured for.
Oh, no kidding. I did not know that.
All policies are different, but a lot of them are like that.
Wow.
So that non-negotiable is obviously your house. But make sure you got plenty of building cover, because you don't want to get to claim time and find you're out of pocket, $300,000 or something like that.
Yeah.
So yes, if you own a house, that's probably your biggest asset. Make sure that's covered. Personal insurance, we've spoken about this at length, but it very much depends on your situation. Not everyone needs a lot of that sort of insurance, but some people, they really should have it. And private health definitely depends on your situation. And like going back to the pregnancy cover, still doesn't pay for everything, does it? You're still going to find several $1,000s. So
Still need some cash.
yeah, so I'd say the home covers the non-negotiable one for me. Probably life insurance is next in line if you've got a family.
Yeah. And I throw like income protection in there as well, because most people's
Yes.
most vital asset is their ability to get out and generate income for their family or for themselves. And if that's compromised, kind of everything falls down. But you're not wrong, Billy, around not knowing the terms of your insurances, because I'm going through a claim at the moment on a property in Queensland I've got, that when I think it was the cyclone around, was it March or April, Queensland got hit pretty hard. And the property up there, I wasn't aware at the time, it didn't flood fully, but some water got in somewhere. And then, the insurer, you can imagine the shit fight I'm having trying to get things sorted in relation to that. A lot of, it's so painful dealing with them, a lot of miscommunication on their part, different people calling me. And then they tried to basically, there was water coming up through the slab, which is called seepage, which is not a good thing. And the way this was all found is there was water damage to the carpet in the front lounge. And so we're like, okay, we've got to check that out. And they're like, okay, they came back just the other week and said, we're going to cover you for the carpet, but the seepage to the concrete, we're not doing anything there, because it could be quite significant if water's seeping up through the slab. And I'm like, hang on, how does that work? The carpet wouldn't be damaged unless you're saying there's an issue with that, and you're not covering that, or you're not going to even investigate it any further. And then they said no. And then I started just pushing back on them. I haven't even raised a complaint yet. And now they've just come back to me this week saying, now we're going to investigate the seepage and see if you're covered for it. I'm like, what's going on here? So yeah, you can't lay down and just cop it when you're dealing with anything insurance, unfortunately. You do have to push and stick up for yourself. But it's a lot of reading those terms and conditions as well, which I don't know, who wants to do that?
ChatGPT wants to do it. It's really let's write for PDSs and product disclosure statements and just feed it all in there. I reckon it's a perfect use case for that.
You're not wrong. Well, what about in closing, Billy? Like, what's the sort of parting message here in terms of reviewing your insurances, making sure you're holding them accountable, you're keeping your costs fair. What do you do? What do you advise?
Well, I was thinking about this because you can spend 100 hours, reading PDSs and things. I reckon it's pretty simple. So personal insurance, if you have a decent need for life and income protection, you should speak to an advisor.
Yeah.
I'm not trying to spruik us because insurance is probably not our favorite part of this job. So any good advisor, any other good advisor, if you want insurance help, they're the experts. They do it every day. They've got access to all the different policies. For your general insurance, home and contents, all that stuff, I would use ChatGPT and a spreadsheet if you want to get really into the weeds, and just look at those high level features and compare those. Don't go down into every bit of detail because you'll be in there for weeks. And then call them up and tell them you're changing, and they'll give you a better deal.
Pretty much.
So they try and do that once a year if you can.
Yeah, and I think it's like an annual audit that you kind of have to do. And that's also when you maybe look at your cash flow, which I try to do at least yearly, is just kind of look at those ins and outs. And a part of that, look at the insurances and, give them a call up. It's not sometimes easy because like with private health insurance, they have different coverage ratios and levels. Some might cover you for 50 and 60%. They call them different things. And it does get a little bit confusing in a way. So sometimes you just got to really, sort of make it simple, and ChatGPT can obviously help out a lot with that. But I would also caution using those, and I won't name names, like those insurance brokers and sites out there, because they will harass you like you have not seen. If you put your details into those comparison sites, you will get absolutely hounded from there. Now, if that's what you want, it's all good.
Well, they've also got backdoor deals with different providers. So they're not, I don't think they're going to recommend the best policy. They're going to recommend whoever pays them the most, right? The biggest referral fee. So I don't like those websites.
Yeah, I would proceed with caution if that would be the case. But of course, insurance is not the most exciting thing, but it's one of those sort of things that you do need in your life, depending upon your situation. Areas that we as advisors don't really like to explore a great deal, but it's just a necessary part of our job. It's not the most exciting, but nevertheless still relevant to ensure our clients are adequately protected. But before we close out, Billy, anything going into the weekend? Anything exciting this week or?
Yeah, it's heading down to Red Hill on the Mornington Peninsula. Friends, family has a really nice house there. Cool. So it's going to get down there, have some barbecues, have a few red wines, that sort of stuff.
What's the weather tomorrow? I seen 23 and 29.
Yeah, it's all over the shop.
But we'll finish up there. As always, appreciate everyone that's listening. If you're getting value out of it, 5 stars on Spotify and Apple, leave us a review. We'll get a lot out of that. And also feel free to reach out if you want to chat about your personal circumstances. But until next week, Billy, I'll see you then, mate.
Thanks, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.